Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. US lawmakers work into the night on Trump's tax and spending bill after House Republicans release a new version aimed at winning over party factions. We'll bring you the latest from DC. European futures are in the red following global stocks lower. Treasury steady for now after Wednesday's weak Treasury auction and deficit fears cause yields to climb. Scott Bessent and his Japanese counterpart agreed to allow markets to determine foreign exchange levels, easing concerns that currencies will feature in trade deals.
A quick check on these markets here. All roads seem to lead back to Washington, though, and that's perhaps what Euro stocks at 50 futures are pricing in. The carnage that you saw in the U.S. session yesterday showing up in the futures picture today, down about 0.6%, as Anna was just mentioning. But a rebound trade, a marginal rebound trade over in the States. S&P futures higher by 0.1%. But again, as Anna mentioned, all eyes on that 30-year yield after that failed 20-year auction. We'll see if that carnage continues. They are 509 on that yield. And then as we see those deficit concerns, bids to the Japanese yen, the Swiss franc, and of course gold as well, returning to the green. The countdown to the opening trade starts right now.
You're looking at live pictures coming from the House of Representatives, or you will be in just a moment when we get to them. Nancy Pelosi currently speaking. As you can see, they have pulled a second all-nighter. We are getting ready, we think, for a vote, as the Washington Post put it this morning, in the wee small hours of Thursday morning. We could see this vote coming through. It looks like it's going to be very, very close. But obviously, we are now tracking the progress of the big, beautiful bill, Kriti. Does it deliver today? Do we get it delivered today? And what impact does it have? Well,
the key piece is they're coming up against a deadline in mid-July, something Scott Bessent has worried about for a very long time. This bill still increases the debt ceiling by about $4 trillion. So those concerns about bringing that deficit down that we're seeing really echo in the markets, we're not quite there yet. And that being said, if this House bill passes, there's still some key hurdles in the Senate. So I don't know. Anything can happen from here.
Yeah, and from a markets perspective, which we'll come to in a moment, clearly a lot of focus on what this does to the deficit. But there are other interesting details in here. We spoke a lot of times about the Inflation Reduction Act in time under Joe Biden. And here we seem to see tax credits coming to an end earlier than had been anticipated. Now, whilst that might be good on the fiscal side, if you're worried about the extent of the debt in the United States, it might bode ill for some of the industrial businesses that we've talked to who've benefited from that.
What happens if it doesn't go through today? That was a question I was trying to kick around a little bit earlier on. Do you get how does the market react? If we do get a vote in the next kind of couple of hours, I don't know exactly what the timing is going to look like. It doesn't look very full right now. If we do get a vote and it fails, how does the market react? Does the market just go, they'll haggle a little bit more and then we'll get to it? Or does the market go, actually, we've got a problem here, and actually maybe the worst outcome here is actually that we get tax rises? I find that very hard to believe. But there do seem to be a few permutations over the next couple of hours. So we could get a little bit of volatility around this. I don't know. Or was the volatility yesterday?
That's the other argument, that maybe the worst is behind us in terms of this reacting to this particular issue, because the assumption going into these negotiations was that Donald Trump's got the House on his side. It was those hard lines on the deficit that he couldn't quite convince. So once you got those folks on your side and really made those amends, you can then move this bill forward. But I think the assumption going into it was the fact that this would be a much cleaner process because the House does have a tiny majority, but a majority nonetheless for the GOP. So this was supposed to be an easier process from the get-go. Yeah. The fact that it wasn't, perhaps the market's already reacted.
Right. Well, let's think about that market reaction, because we still don't know, as you say, Guy, where this goes. If we don't get this through this time, is that just a sort of holding statement and the market says, OK, have some more time. We'll send yields higher in the short term, but have some more time. I suppose if the Republicans or if President Trump and his team believe that growth is the answer here, that growth is what bails you out, then it remains to be seen if the market is going to become convinced of that. And are there going to be other measures that might convince the market that this isn't all negative from the fiscal side and there can be something done on growth? But that's starting to sound a little bit like what the UK went through, and the markets didn't give the UK very long. They'll no doubt give the US longer, but how long?
And then how do you think about stocks and how do you think about bonds? Are they two different buckets? Do bonds react negatively to what happens with the story surrounding the deficit? Do equities start to do better because actually there's a growth story that looks actually fairly favourable, and actually the top line's going to move on the back of that, and in theory the bottom line as well. So I don't know kind of how the various different asset classes react as well. The other interesting thing here is, I was kicking this around with Val a little bit earlier on, do you need to see, in order to attract foreign money, and actually there was plenty of foreign money, it seemed, in yesterday's auction, but in order to keep that coming, do you need to have higher yields in the US and a weaker dollar at the same time? Because that sounds awfully EM-like to me.
Right. I mean, and actually EM assets did OK yesterday. EM stocks certainly were one of the beneficiaries of the money coming out of the US in certain places. Interesting, I saw a take on the bond auction yesterday that described the foreign demand as a little lacklustre. So, you know, maybe that requires a little bit more analysis. 69%.
Indirect bidders came through at 69.
But then the overall message from the bond markets about markets getting yippy, to use President Trump's favourite phrase, from the beginning of April, that is something that we need to think about, because there are some people in that chamber that we're watching there who are busy posting on X images of the bond markets in the hope that that will then force the president's hand to do something different, as we saw at the beginning of April.
And look, he's been spending so much time at Capitol Hill. That's unlike the president to spend this much time in Congress, which tells you just the amount of hurdles that he's talking about. There is a doomsday scenario as well that's come across my radar, which is if you continue to see worse and worse bond auctions, continue to see this weakness, more of this kind of indirect demand, and where a lot of the dealers have to take in more, the banks, of course, on Wall Street, is there a point where they're taking on way more risk than they signed up for? And does that actually put financial stability, the plumbing, in a little bit more peril? That is the worst case scenario. We've only had one poor bond auction kind of at the moment, but it is one to keep in mind if we continue to see this theme that these bidders on both sides of the Atlantic don't want exposure to that long end.
And this links us into our next conversation, because one thing they did not talk about, apparently, the Japanese finance minister and Scott Bessent, was treasuries, was buying of treasuries. They didn't, you know, we can be all reassured that that didn't come up in the conversation.
They did talk about FX.
Yes.
So people are taking different spins on the FX story. They basically said markets should determine the FX story. It's a fundamental story. But that tells you that basically is the US side saying don't intervene in the foreign exchange market? Is that a shock to the Japanese, saying you can't keep the yen kind of under control?
Well, continuity seems to be some people's takeaway as well.
And so there are various spins you can put on this. You've also had the won move overnight as well, the Korean won, which I think is interesting too. The Koreans are indicating that FX was part of the conversation. So I just wonder if there's a sort of element of interpretation in how these various conversations are being perceived. There was clearly sort of no Bamford call, which some people were talking about coming out of the G7. But it does seem as if this FX story is not going away. It's not what was the comments yesterday are not enough, I think, to dismiss this as a story. There's also this whole Russian oil story as well. The UK is pushing to lower the number because obviously oil prices have come down. It's going to be interesting to see ultimately where traction goes on that one. There's also this Wall Street Journal reporting, which I think is fascinating, about the fact that Trump has apparently told European leaders that Putin doesn't want peace and feels he's winning, and therefore this conflict is going to carry on. So does that give extra impetus into this G7 conversation to lower the oil price, to push to Russians even harder?
Yeah, and in the meantime, the Russians have just been using the shadow fleet, as we've reported many times here at Bloomberg anyway. So you wonder, even if they do drop that cap, what difference does that make? Perhaps, I mean, there's huge symbolism, of course, in it.
You went exactly where I said. I'm looking at Brent crude here at a 64.99, 65 handle. The Russia story doesn't seem to be the major mover for this market. It still comes back down to trade.
Absolutely. That seems like more logical. But we'll watch it carefully, nevertheless, because I think it will have wider implications as well. What have we got coming up on the show? Marie-Anne Allier, Carmignac fixed income manager, joining us. That's going to be an interesting conversation, isn't it? As well, a conversation with Kenton Jarvis, the EasyJet's CEO. We've just seen EasyJet numbers dropping onto the tape. We'll come back. We'll analyse those. First half load factor, 87.9. Bang in line with expected numbers. Current booking supportive of meeting 2025 consensus is the line from Kenton. We'll come back to him in just a moment. We'll also be talking to Freddie Lait, Latitude Investment Management managing partner. Very much a kind of non-US tech portfolio at the moment. Does that insulate him? And Monika Schnitzer, German Council of Economic Experts chair, joining us after, I think it's after the German PMI data we're going to be getting. So that'll be a fascinating conversation too.
Absolutely, and plenty more data on the radar for today, mostly on this side of the Atlantic. 9 a.m. UK time. After the German PMI data, we get the German IFO data as well. At the same time, the Euro area flash composite PMIs are going to be hitting the wire. 30 minutes later, the same data set from the UK as well. Got a couple of earnings there on both sides of the Atlantic throughout the day. But then you have the ECB monetary policy account at 12:30, and at 1:30 p.m., UK jobless claims. If we are worried about a labor market that is perhaps more reactive or having a delayed impact, that data set's going to be coming in handy today.
Haven't seen it yet.
Yeah.
Which is interesting. And all the data currently talk to a fairly well-supported labour market in the United States. What else do you need to know this Thursday morning? 2 Israeli embassy staff members have been killed in a shooting near the Jewish Museum in Washington, D.C. Police there say a 30-year-old male suspect approached a group of 4 as they were leaving an event. Officers detained the suspect at the scene. President Trump has called the killings, quote, horrible and based obviously on anti-Semitism. OpenAI is buying EO, assuming I'm pronouncing that correctly. IO? Could be EO, IO. Anyway, it's a secretive device startup co-founded by former Apple veteran Johnny Ive. It's an all-stock deal. We think it's worth nearly $6.5 billion. Ive and OpenAI CEO Sam Altman will now work together to create new AI hardware devices, with their first product expected next year. Ive is, of course, famous for working closely with Steve Jobs and is credited with the design and feel of iconic Apple products such as, the iPhone. Quite significant. And Bloomberg understands the European Union has shared a revised trade proposal with the United States. This as it aims to inject momentum into talks with President Trump's administration. The new paper is said to include proposals to gradually reduce tariffs to 0 on both sides for industrial goods and what it calls, quote, non-sensitive agricultural products. Meanwhile, the LVMH CEO has urged the two sides to engage in constructive talks. Speaking in a French Senate hearing, Bernard Arnault warned of catastrophic consequences for the spirits sector if both the US and China raise tariffs. So I can't work out how far through the 90 days are we? Where are we in terms of the proposals that the Europe? Are we getting progress here? It kind of feels like the European Union is having to push the United States to deliver something here.
Yeah, and the Europeans then coming forward with this proposal of, well, still both sides trying to scope each other out. Doesn't feel as if this is moving very quickly, does it? And I saw interesting lines out of the FT today about what Europe might be prepared to concede on lobsters, if that was going to be something that would push things over the line. Apparently in the past this has proved very influential on the Trump administration, so we won't dismiss it out of hand.
Fishing,
could
back
that
to
be
fishing. It's
I know,
always
what
fishing.
is it with crustaceans and things that live in the sea?
I wouldn't know, I'm vegetarian, so I can't help you with that. But what I will say is I think the agriculture piece is interesting, because that was one of the sticking points between the EU and the UK as well. So the fact that they're actually trying to push these barriers down from the U, or the US is potentially this is potentially a, I don't know what I'm trying to say here. This is a potential discussion point with the U.S. where we know that the standards are higher from U.S. going into Europe. I thought that was really interesting as a potential starting point for these negotiations.
So we will watch that with interest. Coming up on the programme, UniCredit's BPM bid gets a 30-day suspension. We'll check on the shares at the market open. That's in around 45 minutes' time. Plus, we'll stay across all of the latest from D.C. as lawmakers wrestle with President Trump's mammoth tax bill. Up next, Jamie Dimon warns of U.S. stagflation risks. We will hear from him. We'll bring you part of our conversation with him, happened in just the last few hours or so. If you have any questions for our guests, you want to get involved in these conversations around this desk, ID plus BBTV Go is the function to use. The sun is shining once again here in London. This is Bloomberg.
This week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum continues this week right here on Bloomberg Television. Context changes everything.
43 minutes to the market open here in Europe. We've got a lot going on. We're watching what is happening very carefully in Washington, D.C. As we approach potentially a vote on the big, beautiful bill. We'll come to that in a few minutes' time. Let's talk about Jamie Dimon's view of the world. He's been talking once again to Bloomberg, saying he can't rule out the U.S. economy falling into stagflation. The JP Morgan CEO giving an exclusive interview to Bloomberg's Haslinda Amin at the Global China Summit, which has taken place in Shanghai.
You talk about that kind of complacency. I'm talking about the asset price in the United States, and it's a long list of things. It's QE, it's fiscal deficits, it's global fiscal deficits, it's potential the trade wars, it's these huge complex geopolitical situation, and I look at all of those probably not being properly priced into the marketplace. But we don't know what's going to happen. So, I saw last night's reaction. I don't worry about one-day move in bond markets. So.
You don't worry about one day, but when you take a look at yields, they are at higher levels than they were before Liberation Day. I mean, we talked about how 30's higher, and some are talking about 10's getting to 5's, 30's getting to 7%. How are you assessing that? I mean, how high do yields have to go before they reach breaking point?
Yeah, I don't know the answer to that. No, we assess, the way we run the company is we prepare for a full range of outcomes, regardless of what you think. I just think there's a chance that you'll have stagflation. So I'm not saying it's going to happen. I don't want the reader to say he's predicting stagflation. I'm not. But we have to be prepared for something like that. I think the global fiscal deficits are inflationary. I think the remilitarization of the world is inflationary. The restructuring of trade is inflationary, and this is not all an American thing, and the infrastructure needs are inflationary. And now you have offsets. You have oil prices down there quite a bit, which is quite deflationary. But with all those things taking place, yeah, you may be surprised.
As we said, it is a higher yield environment, and you have said before that we could see some sort of rebellion in markets around the world. Is that still a possibility? How might that look like?
Yeah, so I would not call it a high yield environment. I mean, if you look at economic history, rates have been far higher than this, and they surprise people over time. And like I said, I think a lot of the longer term trends have inflationary attributes to them. And so the other thing for your person on TV, credit spreads are low. So you can have two things go against you, which is credit spreads gap out and rates are going up. And so we'll see how it plays out. So I don't want to guess how it plays out. I'm on the cautious side. I'm a little skeptical that we're going to have kind of just an ongoing soft landing here.
I'd be remiss not to ask you about the Fed. Given the higher yield environment, which you say it's not, but it is still higher than what it was before.
Will it go higher?
Will it go higher, and also will it force the Fed's hand?
Yes. I mean, there's always a notion that somehow the Fed is omnipotent and can do whatever it wants. And they do set short-term rates, but they also have to follow the facts. So they raised rates because inflation went up, and they can't control it. Even today, trillions of dollars of these bonds are sold every day. That's done by investors around the world. They cannot control all of that. Foreigners own $35 trillion of U.S. financial tradable assets. And so, they have to react to reality, and that's not a criticism. And they say they're data dependent, but they have to wait and see exactly what happens and then do the appropriate thing.
But the thing is, their reality is different from the reality you have in mind. If you take a look at what Neil Kashkari said, he said the U.S. economy is on solid footing. And some other Fed officials have said that in terms of Fed policy, it is in a very sweet spot. So their reality is quite different.
I think, I don't agree we're in a sweet spot, okay? And I think you have to separate two things. The economy has been doing well. All the facts, we have effectively been in a soft landing. That does not tell you what the future is going to be.
JP Morgan CEO Jamie Dimon is speaking exclusively to Bloomberg with some cautionary words, as we've become used to, perhaps. Yeah. But he's talking about running a business, being prepared for any kind of yield, or many different scenarios, at least, in terms of where the yield goes, which is interesting. You ask someone like Jamie Dimon, how far does this yield story go? And he doesn't know. Lots of people don't know. Everyone's scratching their heads to work out just how high this goes, because the consequences of how high US yields go is just so huge.
This is such a telling interview because this is the man who, as he said, he's an American. He, believes red, white, and blue. He's a patriot. He's always been so confident on that American exceptionalism, consumer resilience story until lately, where his tone has completely changed. In that interview, he made the point as well that he compared yields to the fact that we're not at historical highs. He made comparisons to the 70s and the 80s in the interview. Is that where we're headed in terms of yields?
But it's nice to have that long view, isn't it? Because the world isn't just the last 10 years.
Yeah. So if you exclude the recent spike, you have to go all the way back to 2006, I think, for a US 30-year to be at the current levels we're at right now. And then you kind of zoom out a little bit, and you've got the kind of great moderation when yields came down and down and down and down. But if we're going back, if these are not abnormal yields, then what is an abnormal yield? Is it 70s kind of numbers?
Yeah.
That would be a stretch at the moment, but you do wonder.
Maybe.
There's somewhere in between, though, isn't there? Between a sort of oil-induced massive inflation spike and the slight push higher in inflation that you get from all of the global dynamics that we talked to guests about over the recent years. And Jamie Dimon mentioned some of them there. Deficits, military spending, trade policy, infrastructure investment, energy efficiency policy, all of these things it is possible to put into picture of pushing slightly higher on inflation.
Yep. Equities don't care. Equities are great. Equities are fine. They're just ignoring... And you can make an argument for equities going up in that kind of environment.
And you can show the historical that they do, that they have. As yields have gone up, equities have gone up. You can show that. But then to your point yesterday, how long can you keep doing that? Because surely that cost of debt will weigh on equities at some point.
We'll have to wait and see. There's also the dollar factor in all of this as well.
Yeah.
Like how foreigners are perceiving. Do you need to see those higher yields in order just to have a normal, natural flow? Do you need to see a cheaper dollar, and do you need to see higher yields to attract foreign money going into the United States?
Let us ask for another perspective on this. Marie-Anne Allier joins us, fixed income fund manager at Carmignac. And you join us at a great time in the conversation, Marie-Anne. We're just talking about how high yields can go and what impact that has on other asset classes. But let's stick with the yield story. Jamie Dimon says he doesn't know how high yields go in this situation. I guess we all have to be humble and admit we don't know. But this must be giving you pause for thought. How high are you expecting to see yields go?
Depending on what yields you are talking, is it the 30-year, the 10-year, the 2 years? I think the long part of the curve in the U.S., but also in Europe, in UK, in Japan, we saw that in Japan, can go higher. To what point? It's if Jamie Dimon doesn't know, it's difficult for me to say I know what level will be, but let's say it will go probably higher, 5.2, 5.3. Is it a straight line? We can have a bit of, recede, and 5% can be a threshold difficult to break. But yes, there is multiple reasons why yields could go higher in the next year or something like that.
Do I buy the front end and sell the back end? Is that the trade? Am I on a steepener?
I not even know if I will buy the front end for capital gain, but buying the front end for carry or something like that, yes, for sure. Probably the 2-3 years, maybe the 5 years is hawkish. Even though I don't see why we should have a big rally just in the next 2 or 3 or 4 months. After that, it's difficult to say how the U.S. economy, the European economy will deal with tariff, no tariffs, recession, no recession. So it's a bit difficult at the moment, but yes, for carry, for sure, I think that the short part of the curve are something that you can buy.
Marianne, I'm putting you on the spot here. 20 seconds if you can. Are you seeing that lack of demand and willingness from foreign investors to have exposure to the U.S. long end, just anecdotally? We hear a lot of story of people saying, at the end of the U.S. exceptionalist, people saying that there will be some reallocation from U.S. to Europe, to Japan, to emerging market. I don't, at the moment, hear people seeing effective flows. There is a lot of stories, but when you come to say
have you clients selling the US? I don't see that for the moment. It's probably a slow QT from investors.
Marianne,
in the same,
Marianne, we have to leave that conversation there, but thank you so much for your view on the yield space. We're going to come back to that conversation in just a little bit. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade Thursday morning. Let's have a look at where we are on the futures picture. 7:30 here in London. And futures are suggesting we will be weaker here in London. How much is this a sort of mechanical catch-up with what we saw in the United States? US futures are pretty flat right now, but yesterday's US session saw quite heavy selling later in the day. Some of that attached to what was going on in the bond market, of course, the higher yield story there, the disappointing, in many quarters, auction that was taking place. But US futures, as I say, pretty flat then, Kriti. We did see a little bit of response in terms of higher yields yesterday here in Europe to the US narrative, and I wonder if there's more of that to go this morning.
Certainly inching higher, and we're seeing that on the German 10-year higher by, we'll call it 2 basis points there. The French 10-year by and the Italian 10-year by about the same margin. But let's see how the gilt market opens as well. I'm curious to see what the catch-up trade, the bond market looks like. Yeah,
it's going to be a busy couple of hours. We're going to watch what happens very carefully in Washington, D.C. Let's talk about the summer. Feels like a nice thing to do.
Yes, please.
Yes, it's a sunny morning this morning, so let's carry on that conversation. EasyJet out with its numbers this morning. The load factor looks pretty much in line with estimates. The pre-tax loss a little wider. The revenue just a little off what the market was looking for, but only just slightly. The outlook for the summer, though, looks pretty solid. Kenton Jarvis is the CEO of EasyJet and joins us now. Kenton, good morning. It looks like the summer looks solid. That's what you're pointing us to this morning. You may be a little bit capacity constrained. Just how much visibility do you have? How convinced are you that the summer season looks good?
Well, the signs that we're seeing are very positive. For the June quarter, we're already 80% sold, and that is slightly ahead of where we were this time last year. And then for the quarter July through to September, we're 42% sold. And again, that is ahead of where we were this time last year. So those are positive signs. And we get a little bit more visibility from our holidays business. And we still expect that to grow by 25% this year. So the demand looks good out there. And supply is, as you say, relatively constrained.
Just walk us through the factors behind that, because that's something obviously a lot of airlines are having to deal with right now. Is it the ongoing sort of issues around aircraft and engines and all those sort of things that is affecting the broader market? Can you just give us some more details on why you have that ongoing constraint issue?
Certainly, yes. I mean, both Airbus and Boeing, and it's well publicised, have had difficulties meeting their order books. So all airlines have seen a delay in deliveries, with the majority of deliveries moving out 4, 5, 6 months. And therefore that delay has meant that we're keeping some of our existing fleet for slightly longer, but equally that growth, those growth aircraft aren't coming, and therefore the supply in the market will grow by 1%, 2%, 3% this year.
Kenton, Guy there was talking about kind of the supply story a little bit. I'm curious about the pricing and the demand when it comes to some of the kind of more domestic inward-looking travel relative to more of the international travel. How are you and your company viewing that dynamic?
Well, although the kind of increase in seat capacity this summer is only going to be circa 1% for us, we are flying longer routes. So we're growing our longer leisure flows, we're restoring the city traffic, and actually we're consolidating a little bit the domestic traffic. And with that consolidation, we're seeing good demand supply balance. So the domestics are doing very well.
Well, talk to us about the transatlantic story then. There's a lot of concern about just how much people are going to be traveling from Europe into the United States. Are you seeing a change in those numbers and in those bookings?
It's hard for us to see directly, because obviously we don't offer transatlantic routes. But what we can see is that our bookings are ahead of where they were this time last year. And, it's the usual favourites. It's mainland Spain, it's the Spanish islands, it's Portugal, the Greek islands. We're also seeing more flows into North Africa. We're opening new destinations like Cape Verde, and they're all proving very popular. So if it does become the case that more people stay and holiday within Europe, then that will be obviously a good thing for EasyJet and other European airlines.
Kenton, something else that's sort of a little aside from your business, adjacent to your business, but no doubt will have an impact on the sector at large, is the tariff story. Now, this might not affect the aircraft that you're taking delivery of, not taking any Boeing, but does this have an impact on the availability of Airbus, on your planning around fleet delivery? How are you thinking about the tariff story?
Well, firstly, tariffs change day in, day out at the moment. But what we're doing is obviously working closely with our suppliers to see the impact that it may have in their supply chain. As you say, we're an all Airbus fleet, and therefore Airbus are a European manufacturer, so no immediate issues there with the order book. And obviously the macro picture from tariffs is that there's been a weaker US dollar, and we do a lot of purchasing in dollars, so that's helpful. And the fuel price of oil has come down, so jet aviation fuel's come down. So at the moment, not seeing a big impact for our industry.
Yeah, I wanted to ask you about oil prices, Kenton. What's the sort of rule of thumb? How should we look at oil prices, jet fuel prices, and work out what that does to the cost base at EasyJet?
Well, as we enter the summer, we expect our fuel bill to go down by 8%. And our annual fuel bill is something like 2.4 billion. So that will allow us to offer great fares. So it's going to be an interesting summer because it is relatively short in terms of supply. So my advice would be to book early.
I'm sure, yes. That would certainly work from your end. Kenton, just to stay on the oil story, are you taking advantage of this? Do you think this is the new normal? Do you expect oil prices to stay down here? Are you hedging? Are you changing your strategy around any of this, maybe to lock in some of the lower oil prices, jet fuel prices? What are we, 62, 67 on jet right now? What are you doing with that? Is it an opportunity maybe for not just this year, but also for next year?
Yes, we hedge fuel now 24 months in advance. So we're hedging all the way through 2026 right now. We've already bought and increased our hedge to 83% for the whole of the summer. So we're locking in those good rates, and we're progressively hedging out for next winter and the summer beyond.
In terms, therefore, of what you think is coming, we were talking to Michael the other day. You talk about prices coming down. Are we going to see something of a price war emerging as maybe the opportunity of lower oil prices drives a price war this summer, next summer, as you all have the opportunity to bring prices down as the costs of jet fuel decline and you can lock those in? Are fares going to come down? Is it going to be a disinflationary fare environment that we're looking at as costs come down for you, Wizz, and Ryanair as well?
I'm not sure it'll be a fare down environment because other aspects of the cost base are seeing inflation. And I think with demand pricing, as supply becomes constrained, we'll have to see where the pricing goes. But we always want to offer very affordable fares. That's the purpose of EasyJet, to make low-cost travel easy and affordable. So, we will be looking to pass on the benefits of those fuel savings to our customer, but equally being mindful of other cost positions which may be having different levels of inflation.
Kenton, can I ask you about the EasyJet holidays business? You talked about how you're planning for that to grow at 25%. It's a bit of a different business model the further down that road you go. It's a business model that you have experience of. How should we expect EasyJet to evolve over time as you become more interested in that part of the leisure market?
At the moment, we have about 9 to 10% market share now in the UK of the package travel market. And interestingly, though, when you look at what we call the attachment rate, which is how many people on our international flights are also choosing the accommodation option and therefore taking a package holiday, we're only at 6.4%. So we see a lot of opportunity for more attachment of holidays. It's doing extremely well in the UK. We're now starting to see our European flights having more holidays attached to them, and I think we've got a great opportunity in city breaks as well with flight plus accommodation, and we're working hard on that.
Kenton, any pressure to give more money back to shareholders right now? I know Ryanair's been doing this. Is this something that you feel that you need to be doing as well?
I mean, we are very focused on refleeting. At the moment, we have the older element of our fleet is the A319 subfleet. They're smaller aircraft, less fuel efficient, and therefore, and we've got 82 of those. And we have about 90 aircraft on order over the next 3 years, and we're very keen to bring those into the business and replace the older aircraft so we can maintain a nice young fleet, which will be fuel efficient, better for the environment. So that's our focus now, to bring those aircraft into ownership and strengthen our balance sheet. But we do pay a dividend. We paid a dividend in the half of 20% of last year's profit. And we believe that's a kind of meaningful but sustainable dividend to pay for shareholders.
Kenton, great to catch up. Really appreciate you joining us as we see these numbers come through. Looking like it's going to be maybe a sunny summer. Kenton Jarvis, the CEO of EasyJet. What are we seeing on the screens in front of us?
We've got one eye firmly on what's going on in Washington, D.C. House Republicans accelerating the end of clean energy credits in their giant tax and spending bill. There's a direct read-through in some of the renewable energy sector stocks in Europe. We're going to walk through the details next. Stick with us. This is Bloomberg.
16 minutes to the opening trade here in Europe. At the moment, it looks like futures are fairly negative. We are seeing, obviously, a spill across from what we saw yesterday in the United States. Can I just say that Kriti Gupta has quite the chart this morning, quite the charts, plural.
I tried to squeeze as much information into one chart as possible, which I was told was a no-no when I first started making charts. But I think this is important because it comes back off of yesterday's market action. I was really surprised to see the stock market selling off to this extent on a U.S. Treasury auction, and that, too, in the 20-year yield. And I think it really speaks to the fact that there is that sensitivity to the deficit story. We've heard that anecdotally. We haven't necessarily seen that in the data yet, especially when it comes to that reaction function to the auction. So I did a little digging this morning, and I looked at the 40-day correlations of the S&P 500 with the 2-year, the 10-year, and the 30-year. And that's what these three panels are. The 2-year right here up top. And you can see that as yields go up, you do start to see the stock market rally as well, which to me, again, is kind of counterintuitive. If yields go higher on the front end, isn't that pricing in more inflation, more volatility, perhaps on the trade war story? And you can see a lot of that reaction function has really changed at the start of Liberation Day. And that's kind of really where this piece of the chart is really crucial, because the trade story has changed all of that. But as you go further out into the curve, you are starting to see that correlation go negative. And I think this is really interesting because we're in the early innings of that. This is a 40-day correlation, so it's smoothing over some of the data. But if you continue to see this kind of sensitivity to these auctions, to these deficit worries, if this tax bill isn't pushed across the finish line, and if we don't see the debt ceiling pushed or suspended going into July, this correlation down here can get a lot more negative, Anna. And I think that's what's really crucial, a completely different reaction function to the long end than the short end.
Yeah, absolutely. And it's interesting that the long end and the short end, different reactions. And it's interesting to think about where this goes next then, Guy, because this was a 20-year auction yesterday that disappointed the market. And next week we get the much more closely watched tenors. And so some are anticipating that could have much more of an impact.
It's always the bits you don't expect to be a surprise of the surprise, though. And that's where the 20-year, I think, was quite interesting.
It's only been around a few years.
Pushing it north of 5, I think, was quite to your point, but still quite a decent line in the sand. But, I think there's more interesting action to come. You've also got a Japanese 40-year auction coming up, which I think you want to pay attention to.
Really nerdy.
Yeah, precisely. We're really
we'll get Kriti back with some more charts. We'll
add more of those tenors onto that chart, see how many we can squeeze in there. But I think, again, it's so... What I'm still trying to work out here is that when you do see a 10-year that moves in this kind of direction, the logical thing for the stock market is that it becomes harder to issue debt. You're refinancing at a higher level. And if you were sitting on trillions of dollars of cash, like an Apple or Microsoft, then suddenly that gets less valuable as well.
Yes, and that's how it links to your debt bill and what you have to pay to service your debt. But in terms of what drives yields higher, that's got to have an impact on what it does to stocks, doesn't it? Because some of the periods where we've seen yields going higher is because of strong economies. And yes, that's got inflation pressure built in, but a lot of the companies have proven that they have pricing power. power in inflation environments. And so maybe you don't worry quite so much about stocks in that environment. But what happened yesterday and what's driving worries at the moment is the fiscal side of things, which is again, a different
But this comes back to what Jamie Dimon's talking about. Because in theory, higher yields, stronger economy, great, good for stocks. But if you've got stagflation, not so much.
Yeah.
So that would be maybe a different way of perceiving that narrative.
Let's tap into the thinking of Ven Ram, Bloomberg Markets Live strategist, of course, who joins us to talk about the markets in 3 minutes. And Ven, your thoughts on the link between yields and stocks then? I guess, as we were saying, maybe it depends what is driving yields to go higher. How robust should that connection be right now, do you think?
Well, I think it's going to be working against stocks, acting like gravity on valuations, because, it's one thing to have a strong economy, higher yields. The stock market can withstand that because it means higher earnings. But in this environment where you've got tariffs, where you've got deficits under concern, you've got the threat of inflation and a stagnant economy, it's not going to bode very well for stocks because you're going to essentially discount the present value of future earnings at a higher rate. That is going to pull down stocks, as I was saying. The problem with this recovery, Anna, that we have seen since early April is that, investors are too optimistic. We have seen this movie play out before. And it doesn't end very well because, each time there's been a big crash in the markets, whether it's the great financial crisis or whether you go back to the dot-com crash, the markets always recover or very enthusiastic to recover immediately after the drop, but that proves always like a warning shot for investors, and it doesn't work out very well. Now, if you look at the aggregate earnings per share on the S&P, last year it was about $240. So if you lop off even just a mild 5% of those earnings, and that's very legitimate because the tariff concerns and all that is dogging the U.S. economy. So if you assume an earnings per share aggregate of $225 and assume even a liberal price to earnings of 20 times, you're talking about a valuation of 4,500. We are at 5,800. So there's plenty of way for the correction to go.
In terms of the data we're about to get, we're going to get PMI data. What are you anticipating there out of Europe?
Well, Guy, in the euro area, purchasing managers are going to report that, the economy did fine despite the uncertainty about tariffs. But what matters is, for the big picture, is that, look, the ECB, inflation is under control. The ECB is probably going to cut rates twice more in that cycle. What does that mean? It means that bonds are going to do well, and front-end German bonds are going to do well as well. Now, if you're a dollar-denominated investor, if your portfolio is denominated in dollars, you're actually getting paid to hedge the currency risk for your exposure to the euro. So the 3-month forward premium on the euro-dollar is about 70 basis points. Now, if you annualize that, you get about 240 basis points, which is a fantastic pickup over and above the nominal yield on bonds or front-end bonds. So that means that, even though the nominal yields are lower in Germany, they're much higher than what treasuries offer after adjusting for the currency premium. And therefore, I think that those bonds are going to do well in the current months.
Certainly something we're going to be keeping a very, very close eye on. Bloomberg M Live strategist Ven Ram walking us through some of those market dynamics this morning. We thank you so much. More analysis from him and the team on MLIV Go on your Bloomberg terminals. Go from the macro to the micro. Get our stocks to watch with Joe Easton. Joe.
Morning, Kriti. So EasyJet's numbers looking a little bit light on the revenue today, but the CEO did explain on the show earlier and in the statement as well that the summer bookings looking pretty strong in terms of how much they've sold over the crucial months. Kind of similar to what we saw from Ryanair just a few days ago. But bear in mind, EasyJet has actually underperformed Ryanair quite a lot over the past few years. That's kind of because Ryanair has managed to cut its costs more quickly than EasyJet's. That's kind of the reason for the differing performance for those. So we'll potentially see whether that gap narrows, but we can really see Ryanair doubling, in fact, over the past few years versus EasyJet. Then renewables in focus once again. News from the US that the Republicans are looking to potentially end tax credits for wind energy and other renewable energy more quickly than expected. And we saw just around a week ago that this actually seemed like it was progressing on a positive way. So the tax credits being held. But looks like a bit of a reversal. So we're going to see potentially some weakness in Vestas, maybe Ørsted again, Nordex, Allier, Energia, those kind of wind energy stocks. There is a note from Citi saying that they expect Vestas shares to be weaker this morning because of this. Despite it not being final, they do think this is a negative update and they're bearish on Vestas in this morning's trading. Then finally, in banking M&A, a bit of an update on UniCredit's bid for BPM, the actual bidding process being suspended for around 30 days by the Italian government so that investors can take a better look at the details of the deal and make a more informed decision on whether to actually back this bid. We can see that BPM stock in particular had a massive rally since news of the bid came in November. We can see it rallying then. Actually, we've seen a similar move in UniCredit as well. So both of those in focus as potentially that deal becomes more uncertain in the Italian banking sector this morning.
OK, thank you very much. Joe Easton with some of the stocks in focus. We'll add a few more perhaps. Rio Tinto, the CEO there, Jakob Stausholm, somebody we've spoken to on this programme, is stepping down from the group, waiting for a successor, of course, to be hired. But that's the gist of that news line there. And then perhaps we linger a little more on what's going on oil markets then, Guy, because you flagged this. We've got oil prices retreating on the back of an expectation, according to our reporting, quoting delegates, that we might get another increase in production from OPEC+.
A fairly substantial one. So more supply coming into the market. This as Saudi pushes very hard for those that are not in non-compliance with current quotas. Certainly an internal fight that is happening within OPEC having a meaningful impact around the world. You could also, I suspect, probably fold in also the closer relationship that we're seeing between President Trump and the Saudis right now. But this OPEC headline generating a fairly big response on the downside for the crude market. Does that then extend in 6 minutes into the oil majors here in Europe?
Well, the pressure on the oil market is so interesting because this is coming in tandem as real weakness in the dollar as well. So you would think that there's some sort of floor under the oil market, and not really is the answer here. And NYMEX, I should say, now about to breach the $60 level, a barrel level.
Good for airlines, and that we'll be talking about. We'll be watching EasyJet, won't we? And we just talked to Kenton about the impact that this has on their bottom line and the impact of the weaker dollar as well.
What I'm really fascinated is to see whether it shows up in University of Michigan data. University of Michigan data recently has been pushing, particularly the kind of the inflation expectations component, really sharply to the upside. I always thought that lower gas prices generated a lower kind of inflation outlook within that data. It hasn't recently, which does make you wonder kind of what's going on within some of the kind of inflation outlook numbers that we're watching.
It's all those egg prices and all the egg volatility.
Eggs are coming down as well, apparently, aren't they?
But not that much,
not
right? Coming up, it's the European Open. We're going to dive into it. This is Bloomberg.
Thursday morning, good morning. A couple of minutes ago until the start of trading here in Europe. It's not looking particularly pretty. Let's revisit yesterday and just talk about why it's not looking particularly pretty. Decent rally off the lows yesterday in the European session into the close. We finished near session highs. This is the 20-year auction that we got yesterday in the States that pushed us north of 5%, that the market didn't like very much. As you can see, equities rolled over and finished near session lows. That, Kriti, is what we've got to price in this morning.
And that's exactly where I think futures are headed. When you look at the European story, down about 0.5%. Again, not a major sell-off, perhaps not in tandem with what we saw in the States, but a little bit of a dampener when it comes to risk sentiment. I want to really focus in on the French index, though, because CAC 40 down about 0.5%. It is your underperformer going into the open, Anna.
Let's talk about some of the individual stocks and sectors in focus then this morning, then, Kriti. And EasyJet is in focus, of course. We had numbers out from the aviation business. They're saying they're talking about a strong summer bookings environment. They talked to us. We spoke to Kenton earlier on. He was talking about weaker dollar, lower oil. That lower oil price certainly continues today. So we'll watch EasyJet. We'll watch the whole aviation sector as well. Renewable energy stocks in focus because it seems as part of everything we're watching on Capitol Hill, but lots of bond market implications from the vote that's taking place there on the big, beautiful bill around spending and around tax cuts. Well, there's also mention in there of renewable energies and tax credits that came from the Inflation Reduction Act, and they could be coming to an end quicker than expected. And so as a result, could there be some downward move on some of the wind businesses and other renewable energy businesses in Europe? UniCredit in focus because they seem to have got themselves 30 days extra to talk to regulators and the government about their efforts with regard to BPM. BPM is not happy about that, so we'll watch the Italian banking sector, Guy.
We certainly will. Some single stocks we need to be focusing on, but let's talk about the macro picture as we open this market up this Thursday morning. Here it is, the opening trade. We're expecting it to be fairly negative this morning. We are suffering from a hangover, an American hangover from yesterday's session. The 20-year auction, it's not even an equity market hangover, it's a bond market hangover, but it is causing headaches around the world, and we are starting to see equities rolling over a little bit here in Europe. We're down by 0.2-0.3%. Maybe we'll start to see a few more losses gathering momentum as we start to fully open these markets this morning. We're anticipating that we're going to be down, let's call it circa 0.5%. Not a big move, but that's kind of what we've got now on the screens. The CAC 40 and the DAX both open up around those kinds of levels. This as we price in the turbulence around what we saw on that bond market story yesterday in the United States, and we keep a firm eye on what is happening surrounding what is going on in Washington, D.C. right now as we watch the passage of the big, beautiful bill or not through the House of Representatives. What are we seeing in terms of the sector story, Kriti?
Absolutely. Let's start off with, I think, the biggest weight, and that is really just coming in light of the massive move we've seen in oil in the last, I want to say, 30 minutes or so, and this coming from the OPEC news and the OPEC headlines that they are weighing another hike just yet when it comes to the output. That's going to weigh on oil prices. You're already seeing Shell and BP become very quickly your biggest weights on the index when it comes to the FTSE 100. A similar story, though, that you are seeing in the Stock 600 as well, except that one may be joined by a little bit of weakness in tech.
Yeah, it seems like energy is being sold off in various directions. So you see a weaker oil price, so BP and Shell go down, as you suggest. But then we also see renewable energy under pressure. So Vestas, Ørsted, both of those down by, more than 4% in both cases, more than 6% in the case of Vestas. And this is to do with bringing those tax credits to an end more quickly than have been anticipated over in the United States.
EasyJet's down 5.25% this morning, and in some ways it looks like the market is looking back, not forwards. There's been a miss in terms of the revenue line. That certainly is being felt this morning, and I think that is why you are seeing the stock go lower. Kenton was talking about a solid summer. There's one read you could take on the statement this morning, that it's a little on the vague side when it comes to that outlook, but he sounded fairly convinced. And it's interesting that the oil price story is not factoring into the thinking. So maybe you back that kind of positive news. I haven't seen Ryanair this morning. That positive news
down
on
0.4.
So this is an EasyJet specific story. So Ryanair is down despite the oil price as well. So it's not like the airline sector is getting a boost this morning and EasyJet suffering more. So I think you just need to factor those two stories into that narrative. But it does look as if the numbers are where the miss is, not the outlook from Kenton.
Absolutely. Can we? I'm just going to quickly put a spotlight on another stock they've got my eye on, which is BBVA. It's one of your biggest volume movers to the downside. At least it was initially, and now it's facing a volatility interruption. I'm not seeing a reason for that, but it's one you want to keep an eye on, given that it has that exposure, one, to the United States, and two, to the emerging market story as well. Let's get a little bit more expertise on how to navigate these markets. I'm pleased to say Freddie Lait, managing partner at Latitude Investment Management, joins us around the table. Freddie, lovely to see you this morning. We are trying to work out what the read-through is around the deficit concerns, not only in the States, but arguably if that creates a roadmap for the rest of the world into the equity picture. How responsive should the equity market be to the volatility in the bond market?
Yeah, it's never a good sign when we're talking about bond markets. I think it will. We believe it'll be a repeat of what we saw in the last sort of 6-12 months, really, that there's weaker around the valuations because the US market is still very, very expensive, and the primary driver that it feeds through initially is the valuation level. So very high PE, very high bond yield. You've got alternatives for capital. You've got a higher cost of capital. And then secondarily, it feeds through with higher interest costs, lower consumption, lower demand, lower capex, which is a much longer-term build. So it depends. These bond yields are moving quite rapidly, and I think it will spook the US market in particular. How much it impacts the underlying earnings and operating picture is the bigger question, and that really depends on how much it sustains. And then to the broader equity market, what we've seen so far this year has been very welcome, in our opinion. It's been a rotation. There hasn't been a reduction in equities particularly, but it has moved partially from the US into Japan and Europe and emerging markets and elsewhere. And even intra-US, the very expensive mega-cap stocks have sold off to a large degree, although they've rebounded now. And some of the other less appreciated businesses that are still very high quality have done well. So the more of that, the better and healthier the market could become.
Yeah.
The risk is it could cause some kind of liquidation event and more of a exit from equities full stop. But I don't think we're there yet.
There's this question of how much exposure do you want as an international investor to these dynamics you just laid out in the United States. And I'm curious if that's showing up when it comes to European companies or even British companies that have that exposure to the United States. Are you seeing a difference in the way they trade?
There's certainly been a little bit of people sort of diving through and saying, well, actually, I'd rather have more European exposed stocks, which is the first time in 10 years. Normally, it's just been, I don't know if you remember 15, 20 years ago, when every stock that over-indexed to the EM in the BRICS story traded at a premium. And you could see these scatter charts of everything, EM sales, PE premium. It's been like that with the US for the last 10 years, and I think that's reversing. So it's certainly coming a little bit. What we're seeing in terms of when we talk to the businesses is less capex, less hiring, not necessarily stopping forever or withdrawing from the US, but the incredibly high level of uncertainty with marginally positive news in their domestic markets, meaning they may just rethink some of that allocation. So it's a pause at the moment, rethink, potentially reallocate to other markets.
And are you reallocating a little bit more to Europe? I was looking at the stocks that you own, the top 10 holdings. I see quite a heavy representation of French construction, for example, in there. And we've got ourselves quite excited about the German fiscal plans, of course, in this part of the world. What is that based on?
So we've owned Vinci, which is in the top 10, and Eiffage for about 4 years. The stock's been doing brilliantly. The underlying earnings have been growing 10, 12% a year. It's really an infrastructure business now, more than construction, but it does both. And the stocks went sideways. So they did, if you pull up the chart later, it didn't really move. And then this year, they're both up about 50%. So we've been there for a while. The performance has been delivering at an operating level. And these things are just starting, I would say, to get recognised by international investors. So we've been positioned like this for a number of years. And I think it's starting to see that broadening out, and it's to the benefit.
How high expectations and how much should our portfolios reflect up these expectations for better growth out of Germany then? Because we've got a conversation coming up later on with the Council of Advisors over in Germany, and they've taken their growth forecast for Germany for next year up to 1%. I mean, 1% on the back of all of that spending. Is that all? I mean, how much are you reflecting that in your portfolio?
So we haven't made any real changes this year, so all of the recent 5 months of news flow hasn't really impacted us making decisions and changing. So we're not standing behind huge European growth too much. And the one thing about defence spend is it's very low multiplier on GDP. You build loads of rockets, you put them in a warehouse, you hope you don't use them. It's not terribly constructive for long-term GDP growth. But I think that is one of the core problems that everyone has been talking about, the end of US exceptionalism and capital flight from the US into other regions. And I think those tourists are looking around at the moment and thinking, where can I put capital? But when they get there, it's not all that appealing. And, so I think we're in the very early stages of this discovery rather than a huge flood of capital coming to Europe or the UK.
So what I'm hearing a lot from investors is back off from the US a little bit, rest of the world. What does rest of the world mean at the moment?
Well, that's kind of it. I mean, it's, we've all got our own problems. The situation in the UK is not fantastic.
Yeah.
Exactly.
So where is the rest of the world? If I'm looking at the rest of the world, I've got the US over here, I've got the rest of the world over here. Where's the opportunity in the rest of the world? It doesn't sound like you're convinced that it's in Europe. You've got to be very stock specific. You may have to wait. Is it in EM? Where is it?
So I'm afraid, my answer is that it's very stock specific, and we are picking businesses. They happen to be in France.
But if you were looking, if you started with a blank piece of paper right now, would there be more in emerging markets? Would you be looking elsewhere?
Well, we have the ability to change anything anytime we want. So I still have more than half the portfolio in the US. So there's still a huge amount of value in US businesses. It's just outside of the Nifty 50 and the Mag 7 where all the attention and volatility is and most of the overvaluation is. But just below that, there's thousands of other businesses to consider and look at, and which we think are brilliant. So we just don't invest regionally per se, but I do think...
sorry, Cameron with the thought.
No, I was going to say, I do think that's where the limitation to this argument comes. Everyone says, the US is too expensive. I say that too.
Yep.
And people need to go somewhere else. But when they look somewhere else, it's not that compelling. It's
Precisely.
probably lower trend growth than the US. and it's got its own problems.
But the valuations are maybe that's what.
So a little bit of the valuation's closed, but it's not that attractive.
Is the dollar a headwind to investing in the United States right now? For dollar earners in Europe and B for dollar investors in Europe as well. How big a headwind could that be in terms of detracting from your returns?
So quite a lot of the European equity story in the past 10 years has been growing their sales in the US. And they're now going to get translated back at a 10% lower level. And so factoring that through the models takes away a fair bit from the European equities earnings growth story. So that's not going to be good. It's going to be felt in 6 or 12 months' time when hedges roll off. And in terms of investing in the US, it's always been this wonderful thing. You can buy great companies and clip an extra 3 to 5% on currency.
Yeah.
And so it was a lazy, unhedged, easy way to invest. And suddenly you've been reminded that currency risks matter, even in America. And so I think, again, it just causes that extra layer of volatility or, a higher required return from underlying international investors if they might have to suffer another 10% devaluation on the currency.
Yeah.
So all else equal, valuations should be lower again.
We spoke to a business that has benefited from the weakness in that dollar earlier on. We spoke to the EasyJet's CEO.
Yeah.
And, of course, a lot of the things that you buy as an aviation boss are priced in dollars. And so if that's cheaper for you, then that's all to the good. But you own the sector, don't you? You own Ryanair, which, of course, has done pretty well versus EasyJet over recent past. I mean, how are you looking at that kind of sector right now or that kind of investment?
So, we only bought Ryanair last year, actually, in July, and it's the one airline we buy. So, to be really clear again, it's
because they come with an interesting reputation in terms of long-term value creation.
They do, but they've done very well over a large number of cycles, and I think it's their cost discipline, it's their newer fleet. They've already got the planes they need. Everyone else is desperate to get new ones. EasyJet's CEO was on the show earlier saying he wants to retire his planes, but he can't. Yep. Whereas Ryanair's average plane is only 3 years old. So the sector in general, is doing quite well. Demand is reasonably solid across Europe, potentially seeing a little bit more international flow as well. And the supply of planes is tight because Boeing and Airbus have both, stalled their deliveries. So right now you've got a reasonably good intersection on the supply-demand. Fares are drifting up a little bit. Even Michael O'Leary talking about the ability to have slightly higher fares rather, they've been flat for 20 years, fares in Ryanair. So I think a little bit of positivity in the sector. Lower oil prices will help, but most of them are hedged quite substantially for this year. I think Ryanair's hedged 80% for the whole of the next 12 months, so it'll only feed through for next year's numbers.
Yeah, but at a much lower level. So it is something to bake in.
Freddie,
great to see you. Thanks for stopping by to see us this morning. Thank you very much indeed. Freddie Lait, Managing Partner at Latitude Investment Management. Call 6 looks like this. Quick perusal of what is going on. This is the picture, as you can see, largely red. In fact, very red, particularly Novo Nordisk, which is down quite hard this morning. Oil stocks are certainly under pressure as well. Let's talk about some individual moves. Joe Easton has all of the details.
So we are seeing some movement in EasyJet. It does look like the revenue numbers possibly taking the attention away from those strong summer bookings that the CEO was talking about. Bear in mind, we have just seen that drop down in oil as well, but that doesn't seem to be boosting the stock at the moment. Investors seem to be focusing on that miss on the top line, the ancillary revenue, all those extra seats and snacks, probably not actually as big as expected in terms of the growth on that one. Kind of underperformed Ryanair on that one over a long period. So EasyJet significantly lower today. Then we've got BT. That one actually looked a bit better than I thought. That's probably moved down a bit more than I expected to. But BT, pretty much this is a competition story. I've got weakness in a lot of the key markets. That has been the key theme for them in terms of what we've also seen at Vodafone as well. So seeing earnings flat for the year ahead and a bit of downside coming into BT this morning. Then in defence, Kinetic, I'm not sure how I'm supposed to pronounce that one. I'm going to go with Kinetic Q. It just sounds more fun. But this is a defence company actually listed on the FTSE 100, one of the UK's biggest defence companies, heavily exposed to the US as well, like BAE Systems, but much smaller market cap. But the earnings looking pretty strong. Unsurprisingly, a big order boost for that one today. So Kinetic Q doing pretty well this morning in the UK. Then one stock not doing well is Embracer. Now, I understand this is Lara Croft Tomb Raider, also SpongeBob SquarePants. He doesn't get enough shout-outs on this show, but this is a video game company that makes all of those games that I just mentioned, and they've given a really bad update on not only their games, some delays on some of their games, but also a spin-off of one of their units, which seems to be called Coffee Stain. I wasn't really aware of that one, but that one is heavily hit over in Sweden today, down 12% on Embracer this morning. Then another sector firmly in the red is those renewables. Citi called it right on that one. They said Vestas would be weaker because of these tax credit issues for wind energy in the US. Republicans potentially looking to actually end these credits sooner than expected. So ending potentially in 2029 instead of 2032 is the headline news from that. So Vestas lower, Ørsted, Nordex, EDP, all of them underperforming the drops we're seeing in the broader market today. Then we will finish on one big one that we did have our eye on. This is a massive mover in the UK. Johnson Massey up almost 33%. They're going to sell their catalyst business to Honeywell, £1.8 billion. That was unexpected and a much bigger premium that would have been hoped for that. So we'll keep an eye on Honeywell in the US. Johnson Massey surging 33%, the best performer in the UK following that asset sale this morning.
All right, Joe Easton from our equities team, we thank you so much walking us through some of those early movers. As Joe was speaking, we did get French PMIs crossing the wire. The May composite PMI rising to 48. The forecast was about 48.1, so those numbers coming bang in line with estimates. You are seeing slight, and I emphasize slight, weakness when it comes to the services PMI, though, rising to about a 47.4 reading. The forecast was 47.7, but slight strength. And look, we're still below 50, but manufacturing PMI rising to 49.5. The forecast there was 48.9. So what I'm seeing is better than expected on manufacturing, not as great on services.
We've still got the German number to come, haven't we? That's coming a little bit later on this hour, so we'll certainly bring you that. That one is expected to stay above 50, so we'll see if that materialises. Still to come on this programme, then, US lawmakers work into the night on Trump's tax and spending bill after House Republicans release a new version. That new version designed to bring in those at the edges in the Republican Party who are not keen on voting for it. We're continuing to monitor these pictures as they come to us from Washington. And a reminder that the Qatar Economic Forum is still underway. It's its final day. Currently, Michel Hussein is speaking with the former Greek finance minister, Yanis Varoufakis. You can watch all of the panels that are taking place there in Doha on your Bloomberg terminal. You just type live go and it'll take you to all of the output coming to us from QEF. This is Bloomberg.
I also want to read it and I never regret it. Similarly with Spotify, when it recommends music to me, I actually like it, usually, and sometimes I love it.
Because it knows you very well.
I have trained it to train me to train it to know me.
Isn't that program?
Welcome back. We are 90 minutes, let's call it 20 minutes into the equity market session thus far. As you can see, there's a weakness on the screen in front of you. A number of different factors for that, but one of which is that we are seeing lower crude prices today. That is rippling through into some of the oil majors on the major markets here in Europe. WTI currently flirting with 60. We're at 60.59. Brent a little further north than that. 63.88 is where we're trading at the moment. They're both down, let's call it 1.6%. Bloomberg News reporting that OPEC members are discussing the possibility of another big output hike, which is why you're seeing what you're seeing on the screen in front of you. Bloomberg Senior Executive Editor for Energy and Commodities, the perfect person to talk to. He, of course, Will Kennedy, joins us around the table. What do we know? Why would the Saudis, why would OPEC do this?
Well, it's a continuation of a strategy that they've been pursuing for several months now. A couple of months back, they surprised us with this 3-month-in-one increase of 400,000 barrels a day. Then they did it again, and now it seems that they're talking about doing it a third time, although I should stress that it's not decided yet. The decision will be made next week, and that means over 3 months they would have brought a total of 1.2 million barrels back into the market, which is more than 1% of global oil demand. It's a fairly big move, and obviously we've seen oil prices come down substantially. I think it's interesting, though, that on this news, yes, prices are down, but right now we're still holding firmly above $60 a barrel. So some of the cataclysmic price forecasts that we had heard, especially when the trade war was at full pelt, aren't coming to pass. So maybe that's given them some confidence to pursue and continue pursuing this strategy without the impact on oil prices being completely cataclysmic for their fiscal balances.
Will, what's the doomsday scenario here? If we start to see trade concerns ratchet up, global growth concerns weigh on oil prices, at what point do the Saudis or OPEC broadly look at those falling oil prices and say, we need to reverse course? Is there a line in the sand?
There's always a line in the sand. I think clearly they knew the implications of what they were doing, and I think that the Saudis in particular would have realized that to pursue this strategy will mean that they are going to have to face a period of lower oil prices, and that will have an impact. I don't think there's any sense that these prices are near to that doomsday scenario. Otherwise, they wouldn't be discussing this for a third month in a row. After this, I think a lot of people in the market that our reporters talk to say they may pause and take stock through the summer into the autumn because there are still more barrels that they're keeping off the market. But this has been a pretty substantial move, and I think the Saudis and other leading members are ready for a certain amount of pain.
Will, the idea that they're doing this to stop those who are producing more than they should, why now? Why has that suddenly become such an issue for the Saudis? Or it's just always been an issue? It's
always been an issue for the Saudis. I mean, if you look at the last few years of OPEC policy, one of the most common themes is the Saudi oil minister Abdulaziz berating other OPEC plus members for their failure to comply and trying to force them to make back payments, sort of cuts to rebalance the book with varying amounts of success, shall we say. And I think that one thing that we can say is that patience ran out on the Saudi part, and from their point of view, they're pretty disciplined in their target. If other people are busting targets like that, they're sort of free riding on Saudi discipline, and I think they came to a point where they're losing market share, they're not getting the price benefit, other people are taking advantage, and I think they felt that they needed a different approach.
OK, Will, thank you very much. Bloomberg Senior Executive Editor for Energy and Commodities, Will Kennedy. Now, let us move to other macro matters. The US dollar hovers at a one-month low as Treasury yields and the dollar go in opposite directions. Let's bring in Bloomberg's Valerie Teitel, who has more. So a lot of people are making a lot about the fact that the dollar and the yields are moving in opposite directions. Valerie, how concerned do we need to be about that?
Look, I mean, it is frankly very concerning, but I think the more concerning thing is this theme continues to come back. And it's almost one of those notions that once you see it, you can't unsee it. And I guess the momentum for this trade to come back on any worry about the U.S. deficit is just, it might change the direction of how the market trades from here. There's many weird things going on in the market. One I know that you keep talking about, Guy, the fact that just yields are this high when the economy is slowing. Normally, that's when we get lower yields.
Yeah. Not so high. Jamie Dimon's telling us they're not that high.
Yes, exactly.
But you and I were kicking around this earlier. Is the argument here that in order to attract foreign money, you need a cheaper dollar, and you need higher yields? You see this in other economies. When push comes to shove, that is what gets money back into the economy. Is that what we're seeing here? Effectively, the market forcing us into that kind of a scenario.
Yeah, in some ways, it's a revaluation of U.S. assets, something that normally happens in emerging market economies. You know, like Brazil, for example, has had many of these blow-ups when foreign capital leaves, and the way to attract it back is a central bank hiking aggressively, the currency moving aggressively weaker in order to almost revalue assets in this country to attract them back home. Now, that kind of dynamic is not really one you want to be facing when you have a Treasury market that is set to balloon in size. And I think that's the more concerning thing about this price action. You look at the CBO's projection for how much the Treasury market is going to grow. You know, in 2020, it was 20 trillion. This year, it's set to reach 30 trillion, and in 5 years' time, it's set to reach 40 trillion. So it begs the question, there needs to be another buyer of treasuries out there. And the market is telling us that, yes, the U.S. government, if you want to run these deficits, that's fine, but you're going to have to be paying up here for it.
Walk us through then you just paint out such a doomsday scenario.
Kriti's sort of reeling from that.
I'm like, oh my God, this actually is really, really bad. But I guess what I'm trying to figure out though is there any merit to the idea that the plumbing can't actually stay afloat? Basically, that if there is this much supply, at what point does digestibility become a bigger concern for Wall Street?
Yeah, definitely. And I think it almost begs the question, you know, at what point do Treasury yields really attract Washington to pivot and take a different direction? And I've thought about this for a lot. And I think, you know, it doesn't take just instability in the Treasury market. I think it has to lead on to the corporate bond market, where you see, you know, corporates, maybe the funding frees up for corporates. And maybe that's the big wake up call. I don't think we're there yet, but maybe that's the line in the sand for Washington.
Valerie, thank you very much. Bloomberg's Valerie Teitel with the latest on the bond markets and how that's feeding into other assets. Coming up, German PMIs are due in just a few minutes' time. We had the French numbers. We'll discuss what all this data means for the ECB's reaction function. That conversation next. This is Bloomberg. Welcome back to the opening trade. Right now, our attention goes to Germany and the weakness of this data coming in from Germany. The composite PMI, 48.6. That is back in contraction territory, not above 50, as had been anticipated. So that's below the prior number and below the survey. Where's that weakness coming from? Well, manufacturing is still weak, but that weakness was anticipated. There's further weakness coming in services. So we're down at 47 on the services reading, and the survey was 49. So this is weaker than had been anticipated. This fits in with a fast-moving story around Germany. Yes, weakness in the underlying dynamics of the German economy, but action being taken by the German government. Let's put all of this together and talk to Monika Schnitzer, who's chair of the German Council of Economic Experts, an independent panel that advises Chancellor Friedrich Merz. Monika, nice to have you with us. I wonder your initial response to the weakness of this data. So we have the German composite PMI at 48.6 and more weakness than anticipated in the services side of the economy. Does that make sense to you?
It's not really what we expected because, yes, the economy is not strong. We are stagnating this year, but there are signs of recovery in the sense of we have a fiscal package now implemented by the government. This has actually given quite a lot of expectations that the economy will recover, so I'm a bit surprised.
You're surprised. I mean, does this mean that you came out with new forecasts for the German economy yesterday, Monika, and they showed stagnation as your forecast for 2025? Does this apply downside risk to that forecast? There's a risk we could get contraction in the German economy, I suppose, this year?
It really all depends what's going on with the U.S. Tariff policy. So this definitely has increased uncertainty tremendously. So companies are holding back their investment. They're not sure, should they move production to the U.S., should they not? It really makes companies hold back their investment. So that's bad. And for consumer confidence, we also see that it's still low. So consumers are holding back their purchases. That's also bad. But on the other hand, as I just said, the fiscal package that is going to be implemented gives hope that the economy will be recovering. So at least on the German side, there's now much less uncertainty than there used to be last year.
Monika, good morning. It's Guy. Let's talk about the exciting subject of economic multipliers. I'm wondering what effect we see from this German spending package, how quickly it comes, how much of an effect we actually get. What is your current thinking around that? Because there does seem to be this expectation that we do see a fairly good read across from extra fiscal into economic data.
Yes, that's actually what our report yesterday was about. We did some projections how the fiscal package will impact the German economy, its GDP, also the debt. And we see that it depends really very much on how you spend the money and how quickly. So let's start with how quickly. Yep. If we get this started this year already, which is unlikely because it takes some time, some planning to do, then of course the effect is stronger. But we expect at least next year to the economy picking up. And that already gives our projection of a 1% growth next year. But we do say it really depends on how you spend it. If you spend it on consumption, we are actually very frank, then this is not going to boost the economy a lot. It will boost it to some extent. There's a Keynesian effect then. It will be some effect, but the effect will be so much larger if it's spent on investment, as it should be, because the debt brake that was changed in order to spend it on investment.
What do you think the effect if we do spend it on investment, if the Germans spend it on investment, what effect do you think there will be on the potential growth rate of the German economy?
So we do think that over the next couple of years, the growth of the German economy, or it can increase the German economy quite substantially, and we could expect a growth rate to go well beyond the 1% that we are projecting for next year. So in that sense, there could be actually quite some impact.
Monika, it's Kriti in London. Talk to us a little bit more about that effect. We had a guest on the show earlier talking to us about how the fact that leaning into defense spending may not be as lucrative in terms of the fiscal multiplier that Guy just mentioned, relative to, say, infrastructure spending or other pieces as well. Can you just walk us through the lag or kind of the limited effect of the defense piece specifically?
Exactly. So defense, it's better than consumption, but still the multiplier that we expect for Germany will be below 1. So it's actually not boosting the economy a lot. It will be larger if it's really spent on investment in terms of infrastructure. It will be larger if it's spent on things like research and development. That has the longest effect and the largest effect. So actually also, if you consider how long the effects will last of this fiscal stimulus, it will be longer, more prolonged if it's spent on investment rather than on defense, rather than on consumption.
So in the other pieces of that investment strategy, you mentioned infrastructure, you mentioned research and development there. Are inflation worries going to factor into that or make that project more difficult, or is that a issue of the past?
So it all depends on capacity. And yes, we see for building capacities that we still have quite some room here. If you think about road construction, for instance, there is less capacity left at the moment, less idle capacity. So in that sense, it's really important that the government announces their plans very quickly, because that means then the companies can prepare for the orders that will reach them, and so then they can increase their capacity. I mean, that's the whole idea. The whole idea is that the economy will grow because also capacity will be extended, and the capacity that is there is going to be used. So yes, if the money would be spent right away and just on one thing and the capacity is not there, then there could be some inflation effect. But this is not how we expect things are going to happen.
Monika, what do you think the priority for the German input into the trade conversation between Europe and the United States? What should the priority for Germany be when it comes to that trade conversation?
It's obvious that some sectors are much more affected than others. So we rely a lot on automobiles, on machinery, also on pharmaceuticals and chemicals. So these are the products where we would be very interested in making sure that the tariffs actually come down. So there will be a strong focus of the German administration to talk about these things.
Monika, a final question to you, if I can. I apologize in advance if this is too direct of a question, but I am curious, as we digest the various trains of thought, from trade worries to inflation to supply chain crises, investors seem to be coming on our show time and time again and saying, the world is a tricky place to navigate, except for Germany, because we have this fiscal spend coming down the pike. Monika, I'm curious, what keeps you up at night? What are you worried most about that project coming to fruition?
Actually, I think this project is one of the biggest hope we have at the moment, that things are going well and will be falling into place. So the worry could be that it takes too long to actually put it into action. But I do think the government has the sense of urgency that is needed now to really make things move fast. And the companies are waiting for the money, they are waiting for the orders, and so are the people in Germany.
Monika Schnitzer, lovely to have you on the program. Thank you so much for joining us, Chair of the German Council of Economic Experts, joining the program this morning on Germany's path, or return, I should say, to growth. Let's go from the story over in Germany to the broader EU, which has to be pragmatic and progress, with the coalition of the willing, even on the economic front. At least that's the view of the commissioner in charge of industrial strategy. Yesterday, the EU unveiling plans to cut red tape for medium-sized companies in an effort to catch up with China and the United States. Stéphane Séjourné spoke exclusively with our very own Oliver Crook in Brussels.
We think that the decarbonisation model and the Green Deal are a social and ecological step forward, and deregulation is a step backward.
Environnementale et climatique. Et donc, on essaye.
So we're trying to push to eliminate the red tape as much as possible while maintaining the objectives of the European model.
Toute la tech, toutes les big five.
The tech sector, the Big Five, which were targeted by the Trump administration, the pharmaceutical and auto sectors, steel and aluminium, these are strategic sectors that drive growth, have a massive impact on European GDP and create jobs.
Et en plus, créer des emplois en Europe.
I have put in place a mechanism to call all the CEOs who were contacted by the Trump administration and to reiterate the positive simplification and pro-business agenda of the EU Commission in the coming months.
De la Commission européenne dans ces prochains mois.
Now you have the plan. Now there's a question of implementing the plan and getting potentially consensus among 27, EU member states. Always a challenge. There's also been an idea, and you've talked about this a little bit, of maybe going about this piecemeal, saying, a coalition of the willing, and then they could see they unlock the benefits. How are you sort of proposing to go about this? What is going to be the most effective way to actually make this a reality?
Il faut être là aussi très pragmatique, et je pense que la Commission européenne a par le passé.
We have to be very pragmatic. I think that in the past, the European Commission has been dogmatic by needing all 27 member states to agree before moving forward.
On a choisi de changer de méthode.
We are changing this approach so we can work with coalitions of the willing. This should also encourage others to join.
De rallier les autres.
You just evoked there the idea of a potentially closure of the American markets to the European, something that you need to potentially prepare for. What are the chances of that? How realistic a possibility do you think that is?
Depuis maintenant quelques semaines, il y a des discussions, mais des discussions qui sont sur le.
For the past few weeks, there's been discussion on the perimeter, but not on details of the tariffs.
Des tarifs. Je pense que cette période que nous vivons est inédite en elle-même.
I think the period that we're living in is unprecedented due to the uncertainty in markets and the unpredictability of the Trump administration.
Trump, il faut le dire en transparence. Peut-être et j'espère que.
I hope that things will stabilize and that the Americans will remain simple and loyal partners for the Europeans.
Loyaux, en tout cas, c'est ce que nous sommes et ce que nous considérons être.
Stéphane Séjourné, the EU Commissioner in charge of industrial strategy, speaking there to Bloomberg's Oliver Crook. We'll return to the corporate story next. EasyJet shares under a little bit of pressure this morning at the start of European trading. As you can see, they have narrowed the earlier losses. The budget carrier reporting a bit of a revenue miss. Positive outlook, but revenue miss. We'll dig into the details next. And a reminder that the Qatar Economic Forum is underway in its final day. Currently, Francine Lacroix is moderating a panel on the tech investor outlook. You can watch that panel if you would like to do so. We've got a good show still going on here, but if you want to watch that, live go on your Bloomberg terminal is the function that you can use.
Learning that AI is able to do, it starts to create what I'll call, well, we're calling it generative AI, but really becoming creative, right? And not just being an efficiency tool. I think that's the utopia that we're all working towards, and as we get there, I think the sort of horizons open up even larger.
I want to actually ask Chris about valuations and whether some of the AI is overhyped.
Red with a tinge of orange, becoming a little less red. The stock was down quite hard at the beginning of the session. EasyJet now down 1.7%. The company out with a little bit of a revenue miss this morning, and that is obviously a factor in terms of why we're seeing what we're seeing on the share price. But the budget carrier is looking to renew its fleet. It's talking about a fairly solid summer, but it does face supply chain challenges, as do many airlines at the moment. We spoke to the company's CEO, Kenton Jarvis. He says the industry is benefiting, despite all of the headwinds, from a lower oil price.
As we enter the summer, we expect our fuel bill to go down by 8%, and our annual fuel bill is something like 2.4 billion. So that will allow us to offer great fares. We will be looking to pass on the benefits of those fuel savings to our customer, but equally being mindful of other cost positions which may be having different levels of inflation.
on the one hand. On the other hand, there are different factors coming into the mix in terms of what EasyJet is seeing right now. Kate Duffy covers the carrier for us and joins us around the table. You've been on the media call, which was fairly short, and what we're learning this morning is that basically a little bit of a revenue miss, fairly solid outlook for the summer, but still quite a lot of vagueness around what exactly we are going to get from this airline going forward.
Yeah, absolutely. So EasyJet was reporting a strong summer outlook for flights and their EasyJet holidays as well, their package holiday business. So that's looking positive. One thing that he did highlight during the interview was this sort of constrained capacity across Europe. And this is ultimately driven by the delivery delays at Airbus, which is EasyJet is an all Airbus fleet, obviously, but also Boeing starts affecting other airlines as well. So
is that why we're getting the vagueness?
Potentially, I think there's a certain uncertainty in the industry about how quickly the manufacturers can get the jets out of the door. And for EasyJet, they're looking to sort of renew their fleet, renew the older aircraft that are more fuel guzzling with these newer jets that are more fuel efficient, so they can potentially save money and be more sustainable in the future. So that's the main worry for EasyJet at the moment, just replacing these older aircraft as we go forward. But as Kenton said, there could be some impact, positive impact with the oil prices and the fact that they're a budget carrier as well, offering these lower fares. That could be a positive.
How does that compare to the problems at Ryanair?
Ryanair has an all-Boeing fleet, so they've obviously struggled with a lot of Boeing delivery delays over the past year or so. They're now coming into the grapple of potential tariffs on their aircraft too, so that's something they're looking out for. But with EasyJet, obviously we're seeing the stock is down, whereas on Monday Ryanair stock was considerably high, in fact record levels, and this is primarily down to the fact that there's potentially a better outlook for Ryanair going forward in terms of shareholder returns, and also the fact that EasyJet has a very UK-focused network, and a lot of consumer sort of cost of living crisis is more sort of centred around the UK at the moment compared to the rest of Europe, where travel is actually looking very, very strong.
And where does that leave the outlook for travel in the summer then, Kate? Because we've heard a lot from maybe the bigger global airlines talking about a lack of willingness to visit the US or weaker transatlantic routes. That doesn't play directly to the disadvantage of EasyJet. In fact, maybe it benefits them.
Yeah, I mean, it's certainly a good time to be a European airline at the moment. You have these low oil prices, and as you said, like these legacy carriers, British Airways, Virgin and Air France and Lufthansa, they've all reported a slight softness in the transatlantic demand between the US and Europe at the moment. Whereas, Europe, there's strong demand. People want to travel. Michael O'Leary was saying on Monday, people in Europe, they want to stick closer to home instead of going across to the US. So that's definitely a positive, but there are still risks in the industry, of course. There is the geopolitical conflicts that we're seeing across the region. There is that potential, do we have to cancel flights? Do we have to rejig our capacity? Airlines are considering this. But also the situation of tariffs, of course, as well. If there are tariffs imposed potentially on an aircraft, for Boeing, then there could be implications for Ryanair. And then what is their next move? Are they going to take aircraft in the UK, or are they going to sort of delay deliveries or even cancel them, as O'Leary has suggested?
Kate, thank you very much. Bloomberg's Kate Duffy with the aviation news of the morning. And in fact, sticking with that sector, Qatar Airways says it could still buy wide-body jets from Airbus in the future, just days after announcing a record order for 210 long-haul jets from Boeing. Bloomberg spoke with the airline CEO at the Qatar Economic Forum.
Our narrow body will continue to be Airbus. We're receiving 50 321 Neos starting next year. So our whole narrow body fleet will be basically operated by Airbus. We continue to receive 350-1000, and there will always be a chance for another order from Airbus.
The conversation over in Doha with the Qatar Airways CEO over at the Qatar Economic Forum. Let's switch focus to, I think, what is our top story of today. We are, of course, waiting on the vote in Washington when it comes to the one big, beautiful bill. Let's get the latest on that and bring in our very own Charlie Wells and Valerie Titel, who are watching this very, very closely. It's rare that at 8:52 in the morning here in the UK, we're talking about what's going on in Washington, D.C., but the House Republicans staying late. Charlie, I'm going to start with you here. Walk us through what we expect in these next couple of hours.
Yeah, Kriti, I mean, we're really getting down to the wire here, right? So we've been seeing them work through the night. And this is really important because Mike Johnson, the Speaker of the House, has set a deadline of Memorial Day in just a few days. So down to the wire. And we know that this bill has passed a key procedural vote over the terms of the debate. It's moving forward. And there are some changes here, and these have been notable. And it just speaks to the sort of cantilever that Mike Johnson has had to try to balance under pressure, where he's got the SALT caucus. So these are Republicans from traditionally blue states. We see an increase in the deductions on that SALT cap from $10,000 to $40,000. So that is kind of trying to assuage their concerns. But on the other end of the spectrum, within that Republican Party, you are seeing the ultra-conservatives, and they have wanted a lot of cuts here. And we're seeing an acceleration of work requirements for Medicaid, that is the entitlement program for lower-income Americans. We're seeing an acceleration of work requirements from 2029 to 2026. But the concern for them still is how this contributes to deficits to the tune of trillions of dollars.
Still got to go over the road. Still got to go to the Senate. How's that going to work?
Yeah, so look, it's a long journey ahead. I mean, today is going to be important, but still, I mean, if anyone looks back at history, they know that when a bill goes from the House to the Senate, there tends to be something of a moderating effect. We know that the Senate tends to be a little bit more moderate politically, but also they're on a different calendar here, right? They have 6-year terms. The president's got 4 in the House. They've got 2. And so that just creates a different set of incentives. And if we think back, say, to the Biden administration, we knew this is where a lot of those big pieces of legislation, they died because of just a few members of the Senate.
OK, and what does all this mean for markets? Let's bring in Valerie. We've talked a lot about how the bond markets have reacted to this. Do we get any sense of how markets are positioned if we get an approval of this bill or if this bill fails?
Yeah, I think, at least for markets, it's not a make or break moment, this vote today. I think there's still a lot of time on the table to get this bill passed. And so I think the market reaction might be limited unless it fails by a very large margin, which would maybe entail, months of delays. It was interesting to me, though, that the price action we saw going into this is kind of like a reverse TARP. Back in the GFC, we had the markets really urging Congress to pass a bill. It seems like the bond market is urging patience when passing this bill. So that's maybe a bit of word from the bond market on that.
But this was something that was supposed to be easy, at least circa November 2024, that if you have a razor-thin majority in the House, but a House majority nevertheless, a Senate Republican majority as well, Donald Trump was, in theory, at least the way that it was presented, able to actually get in and pass anything. Val, I want to get your take in a moment, but Charlie, weigh in on that.
Yeah, well, I mean, Val brings up this great point about the Obama era. And let's remember, in that first year of his presidency, they had the trifecta. It was looking like this legislation was going to be such a slam dunk. You go into that first summer, 2009, what's going on? You've got these town halls across the country about Obamacare. Do you remember those and how long it took? So going in, thinking this is going to be quick, thinking it's going to be easy, I think that's a mistake.
Charlie sounds scarred.
I think we all are, but is that perhaps where the mispricing lies, Val?
Well, I guess you can argue maybe the bullish side to this, Kriti, is that once this bill is passed, this is really Trump's economic agenda done, and that just creates maybe a fall of uncertainty across the cards because he's done the tariffs. He's now, good progress on this tax bill. How many more surprises should the markets be prepared for that?
A few. Many more. What are we? 22nd of May, 2025. Thank you very much to Valerie Teitelt and Charlie Wells for setting us up for one of the big items on our calendar, on our daybook, in terms of the trading day ahead, and that is watching this vote that is still taking place or yet to take place over in Washington. We've had data out from Europe already. We have more to come, though, folks, in the shape of the German IFO. That's coming imminently. We also get the UK flash composite PMI, so we'll watch out for those as well.
Yep. We're just waiting for the vote, though, really. That's going to be the main event of the day. We'll keep you covered on what exactly is happening there and what's coming out of D.C. That's going to be the story. We've got it covered right here at Bloomberg. This is Bloomberg.